When people talk about wealth, they often talk about outcomes, net worth, stock picks, or legendary returns. But when we talk about Warren Buffett, outcomes are the least interesting part of the story. What matters is the system behind those outcomes. Because Buffett did not become wealthy by predicting markets, chasing trends, or reacting faster than others. He became wealthy by constructing a framework so resilient that it survived recessions, bubbles, inflation, wars, and technological revolutions. By 1965, when Buffett took control of Berkshire Hathaway, the company was a struggling textile manufacturer. By 2024, Berkshire's market capitalization exceeded $850 billion, with Buffett personally worth over $120 billion, despite starting with no inheritance, no leverage, and no Silicon Valley-style scale advantages. This was not accidental. It was engineered. Buffett's success is often simplified into slogans: buy and hold, value investing, circle of competence. But slogans obscure the discipline. What follows are not motivational rules. These are structural rules, rules Buffett followed consistently, sometimes painfully, and often against popular opinion. This is a critical examination of 6 rules Buffett actually lived by, supported by numbers, quotes, and decisions that shaped one of the most extraordinary financial records in modern history. Rule 1. Never lose capital, not emotionally, not structurally. Buffett's most famous line is often quoted incorrectly. He did not say, "Never lose money." What he actually said was this: Rule number 1, never lose money. Rule number 2, never forget rule number 1. But Buffett later clarified that this was not about avoiding temporary price declines. It was about avoiding permanent loss of capital. In his 1985 Berkshire Hathaway shareholder letter, Buffett wrote that risk is not volatility. Risk is the possibility of permanent capital loss. This distinction is crucial. Most investors confuse price movement with risk. Buffett does not. From 1965 to 2023, Berkshire Hathaway compounded at approximately 19.8% annually, compared with about 10.2% for the S&P 500 including dividends. This compounding only works if large drawdowns are avoided. A 50% loss requires a 100% gain to recover. Buffett structured his entire investment philosophy to avoid such asymmetry. One of the clearest demonstrations of this rule occurred during the dot-com bubble of the late 1990s. Between 1995 and 1999, the Nasdaq Composite rose more than 400%. Buffett refused to participate. Berkshire underperformed dramatically. Critics openly mocked him. In 1999, Berkshire's stock fell 19%, while the S&P 500 rose 21%. Buffett did not react. When the bubble collapsed between 2000 and 2002, the Nasdaq fell nearly 78%. Berkshire lost far less and preserved capital while others were wiped out. Buffett later said in his 2000 shareholder letter that he did not understand the economics of many internet businesses and therefore refused to invest, regardless of short-term underperformance. This rule is not conservative. It is mathematically aggressive. Avoiding ruin allows compounding to operate uninterrupted over decades. Buffett understood that survival is the prerequisite for success. Rule 2. Buy businesses, not stocks. Buffett's second rule is structural. He does not view stocks as symbols on a screen. He views them as partial ownership in businesses. This principle crystallized in the early 1970s after Buffett read Philip Fisher, whose influence shifted Buffett away from strictly buying cheap companies toward buying high-quality businesses at fair prices. Buffett later admitted that this shift dramatically changed his trajectory. In 1972, Berkshire acquired See's Candies for $25 million, despite tangible assets of only $8 million. Traditional value investors criticized the purchase as expensive, but See's generated extraordinary returns. Over the next several decades, it produced over $2 billion in cumulative pre-tax earnings with minimal additional capital investment. Buffett frequently cited See's Candies as one of the most important lessons of his career. Why? Because it demonstrated pricing power, brand loyalty, and capital efficiency. This same logic applied to Berkshire's investment in Coca-Cola in 1988. Buffett invested roughly $1.3 billion. Coca-Cola was not cheap by traditional metrics, but it possessed global distribution, brand dominance, and pricing power. By the 2010s, Berkshire was receiving over $700 million per year in dividends from Coca-Cola alone, while still holding the original shares. Buffett said in his 1988 shareholder letter, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This rule forces long-term thinking. When Buffett buys a stock, he asks whether he would be comfortable owning the business if the stock market closed for 10 years. That mindset eliminates speculation by design. Rule 3. Stay within a strict circle of competence. Buffett does not claim to understand everything. In fact, he openly embraces ignorance as a competitive advantage. He famously said, "Risk comes from not knowing what you're doing." The concept of a circle of competence means understanding not just a business, but the durability of its economics. Buffett avoided technology stocks for decades, not because he disliked innovation, but because he could not reliably predict competitive outcomes. This discipline cost him short-term performance during tech booms, but it preserved capital repeatedly. When Buffett finally invested in Apple starting in 2016, it was not because Apple was a tech company. Buffett explicitly stated that he viewed Apple as a consumer products business with extraordinary brand loyalty and ecosystem lock-in. By 2023, Apple represented over 45% of Berkshire's equity portfolio, generating tens of billions in unrealized gains. Buffett described Apple as probably the best business I know in the world. This was not a contradiction of his philosophy. It was an extension of it. Apple had become understandable within Buffett's circle. The lesson here is not diversification for safety. Buffett has often said that diversification is protection against ignorance. His success came from concentration within competence, not broad exposure. Rule 4. Let time, not activity, do the work. Buffett's wealth is often attributed to high returns. In reality, it is primarily the result of time. Buffett earned over 90% of his net worth after age 50, over 50% after age 65. This is not because he suddenly became better at investing, but because compounding accelerates exponentially over long periods. In his 1999 shareholder letter, Buffett illustrated how compounding works by comparing long-term growth rates. A 10% return compounded over 50 years turns $1 into $117. At 20%, it becomes $9,100. The difference is patience. Buffett rarely trades. Berkshire's portfolio turnover is extremely low. He once joked that his favorite holding period is forever. This is not laziness. It is structural efficiency. Trading incurs taxes, friction, and behavioral errors. Buffett has repeatedly warned that activity is the enemy of returns. In his 2013 letter, he criticized hedge funds for excessive trading and fees, noting that even talented managers struggle to outperform after costs. This rule explains why Buffett famously won a $1 million bet against hedge funds, proving that a low-cost S&P 500 index fund would outperform actively managed funds over a 10-year period. Time magnifies discipline. It punishes impatience. Rule 5. Align incentives and avoid leverage. Buffett is deeply suspicious of leverage. He has described debt as financial heroin, powerful in small doses, deadly when abused. Berkshire Hathaway operates with minimal debt relative to its cash flows. Buffett has said repeatedly that he never wants to rely on external capital during a crisis. This allowed Berkshire to act decisively during the 2008 financial crisis, when it invested billions into Goldman Sachs and General Electric on highly favorable terms. Those deals generated billions in profit precisely because Berkshire had liquidity when others did not. Equally important is incentive alignment. Buffett structured Berkshire so that subsidiary managers are paid based on long-term performance, not quarterly targets. This structure reduced bureaucracy and preserved entrepreneurial incentives. Buffett wrote in multiple letters that culture, once lost, cannot be restored by policy. Avoiding leverage and aligning incentives are not conservative choices. They are volatility dampeners that allow opportunistic aggression when conditions are favorable. Rule 6. Temperament matters more than intelligence. Buffett has repeatedly said that investing does not require genius. It requires emotional stability. He once stated, "You don't need to be extraordinarily smart. You need to be able to control your emotions." This rule is perhaps the hardest. Buffett remained calm during crashes, patient during booms, and indifferent to criticism. He ignored macro predictions, interest rate forecasts, and geopolitical speculation. His letters consistently emphasize rationality, humility, and long-term thinking. Buffett understood that markets are emotional machines in the short run and weighing machines in the long run. This temperament allowed him to act when others froze and to wait when others rushed. Closing reflection. Warren Buffett did not win by predicting the future. He won by designing a system that did not require prediction. These 6 rules are not shortcuts. They are constraints. And within those constraints, Buffett allowed compounding, discipline, and patience to do their work. Buffett's greatest lesson is not about money. It is about how systems outperform instincts and how restraint, applied consistently over decades, can produce extraordinary outcomes. If wealth is built slowly, it is not because the path is unclear. It is because the discipline required is rare. And Buffett proved that rarity, compounded over time, is everything.